Hello guys, welcome to Index Trader channel. Today we are going to see Nifty analysis for this week 29th June. It's a continuation video of last Sunday. So according to last Sunday, we discussed that Nifty will be turning bearish and it will fall. So that's what we discussed. The range given was around 10,300 to 9,800. But Nifty was not that we went wrong or the market went wrong. Market is always supreme, but certain things we need to clear and iron it out that when the market is moving out of our analysis, then definitely we need to look for the data to support that. If suppose market is moving from bearish to bullish, then definitely there has to be some data supporting that. And similarly, if the market is turning from bullish to bearish, there has to be certain data to support that. So first we will go through what are the datas which went against us and what are the datas which we really need to see in the Nifty analysis, and then we proceed on with our current week analysis. So this is our first setup, that is the Nifty EMA setup. Here we 10,244 and we expected that it will fall from there and to the 9,800 levels, but Nifty instead went upside and touched 200 EMA. That is 200 EMA I have plotted here. So we can see that now the 200 EMA is acting as a resistance. It took speculative movement. Speculative movements means mainly because of the derivative part. So in the derivative part we saw that FIIs took long positions and because of that market went upside, but they were closing the long positions till Friday, but after that they keep closing that thing, but at the same time market went upside also on Monday and Tuesday, and Wednesday there was a huge fall from the top, that is near the 200 EMA, and Fibonacci level also we can see that it is 61.8%, exactly our levels, that is 10,552 level. So from that market fell to near to 10,300 levels, and next day gap down, that is 10,200 level. So what data we need to see that? So here we can see that the volume was not consistent in the up move, and before that also only on 19th we can see some volume, but on 18, 16, 17, 18 and all there was not a big volume at all. So that is the reason it was a speculative movement, we can conclude. And also other data we need to look for, that is the main Nifty 50 equity stocks. There are total 50 stocks. In that 50 stocks we can see that around Nifty moved 15% upside in June month alone, and there are around 5 to 6 stocks, handful of stocks that went around more than 20% and up to 60%. Bajaj Finance was 60%. So these stocks were index managed. From these stocks index management was done, and Reliance also you can see that it single-handedly 23% upside was seen, and because of it Nifty moved 15% in June month alone. So there was some speculative activity that happened in the Bajaj Finance, Finserv, IndusInd Bank, BPCL, VEDL. So these are all not a good buying sector, we can say. They are all stressful sectors like financial institutions, banks, and especially auto sector. So even energy also, they are all beaten down stocks, beaten down sector, but right now performing. So if they are performing in this season, then definitely they are going to not going to perform in the coming session. So that is the reason it was index managed and it went up. So it is purely because of the short covering rally and not because of any buying activity. So the supporting data is here we can see that it's a third party site. So in here we can see the historical returns. Here you can see that Nifty was 15% upside in 1 month, and some of the sectors, that is Nifty Bank was 23.8%, the Nifty Finance was 22%, then Nifty Energy was 18%, Nifty Reality was 27%, and the worst performing sector, that is Nifty PSU banks, more stressed sector it is, and it performed 38.8%. So overall these were the sectors that outperformed Nifty and supported Nifty to move up. Returns, even in this pandemic situation, there is going to be negative returns in the next quarter. So we are expecting a negative returns in this next quarter, and this sector is moving up, so it's something fishy. So it is definitely a trap for the investors. That is what looking like. The sectors which are not performing is moving, so that is why we need to be very cautious, and we need to look for the analysis and wait for the levels. Simply blindly we are going in the trend which is not favorable is not going to help us. It will definitely going to trap us. And also we need to look for the FII's data here. So they were net sellers, and previously 4 or 5 days they were net buyers, but before that they were continuously selling, and that too also not supporting data. They were even though their gross purchase and gross sales were much higher, but their net purchase and net sales were not good. Net sales were they were net sellers, we can say, and DIIs we can ignore that because there is no much activity there, but overall they are also in net selling way. So where is the cash buying happening? If both of them were not buying heavily, then definitely market is going to fall. So that is what it's giving a clear definition, and if it is going against our trend, we need to wait for it to follow our trend analysis. Now one important thing we need to look for is FIIs are continuously taking short positions in futures, and they are closing long positions from last week. So from 23rd, 24th you can see here, and 25th we can see here. So they are continuously taking shorts on futures, and they voluntarily, what they have actually done is they had taken all the shorts from proprietary traders and clients, that is the retailers. So retailers and the proprietary traders, they were taking heavy shorts. So what they have done is they have taken out all the shorts, covered their shorts, and because of it market went upside, and they have taken the that is confirming the speculative move. Now we move on to the current one. So current week analysis, we can see that this 200 EMA is acting as a resistance. So we need to follow one thing, look for a thing here. So previously EMA 40 was acting as a resistance, and from there it fell down, and with huge volume support it broke on the EMA 40, and from there it tried to break 100 EMA. From that also it fall backs to EMA 20. Here also it fall backs to EMA 20. Here also it fall backs to EMA 20, and from that it should move upside to break this EMA 200 with higher volumes, but there is no higher volume. Because of that the fall happened. But in the coming days also, even if it falls down to EMA 20, it has to take support from there and then with volume, so that it can break EMA 200. But if there is no volume there, then definitely the sellers, the bearish institutions, whether the FIIs or DIIs, they will take down the index to downside. So that is what we can see. So EMA 20 will be acting as a strong support. Once this will break, it will definitely take this down. And in the weekly setup also, we can see that this EMA 40 is acting as a strong resistance, and because of it we can saw some selling activity happen at the EMA levels, and after that there was a range bound session, there was consolidation happen. So this week is going to be a big week, because whether this trend will be continuously going upside towards next level, that is 10,730, or it is going to fall back to EMA 20. So that's what we need to look for. In the Fibonacci also it is looking like that. 61.8% is the retracement levels for the Nifty. Whenever the Nifty falls down to 0%, from there it retraced to 61.8%. Usually 50%, up to 50% it will take, but beyond that 61.8% is okay. But if it goes above the 61.8%, then definitely the uptrend will be continued. So I have backtested it. I will show that also. So from 0% falls from 0% to 61.8%, it moved up. So that was a range bound session for a long time, almost for a 6 months time, and then it went to 61.8%. but now we can say only for 3 months time it went to 61.8% level, and after that it fell back to 50%, 38.2%, and from that it reaches to the top, and after a long time it didn't fell. So we can say that once it goes above 61.8%, the trend will continue. But as of now, any of the data is not confirming 61.8% supporting level, and also moving towards 11,000 also. Some of our friends asked me the market will be bullish and it will touch definitely 11,000 before falling down. But I need to confirm that there is none other data confirming the movement of no other data confirming data for movement of 11,000. Even in the option chain, we can say in the option chain this week there was a huge OI build-up at 11,000, which is out of the money. Out of the money, usually OI build-up happen because of the call buying and not because of the call writing. So the buyers will be active at the 11,000 strike and also at the 10,500 and even also 9,900 also we can see some build-up here. So what it suggests, whether it is a institution buyers or it is a retailers, because some of the retailers are telling that 11,000 there is a huge OI build-up and because of it definitely this week going to hit 11,000, but that is not the case. Why it is, we will analyze in detail. And at the put side we can see that the support is at 10,000 and 10,300 we can see some support, 10,100 also we can see some support, but overall put side is somewhat weaker, we can see, because once 10,300 is broken then the next level will be the 10,000 only. So it is very weak in terms of put side, but at the call side very strong at 10,500 and 10,400 also. But this OI build-up is built by who? So that is a big question mark. We will analyze in detail. So we will move into the probability decay analysis. What is decay analysis? We need to identify who is active in the market, whether the sellers or the buyers. If the premium decays, premium decay means premium goes in negative. So here you can see that the average premium is going in negative on the call side as well as the put side. So it is a third party site which is giving a decay analysis. So in the decay analysis we can see that call side is less decayed than the put side. So that means put writers are more active than the call writers. So that is the reason the decay happened more on the put side rather on the call side. But at the same time we need to see the probability here. So which strike is going to hit. So in the probability you need to write down the market price and the at the money call IV and the at the money put IV here and put summit. You can see that the probability of hitting the strikes will come here. So here you can see that the probability of 400 is likely more, because only 17 points, so it is as good as in the money, only at the money. So 10,400 we can ignore. So current market price is 10,383, so we can ignore 10,400. But we need to see that 10,500 and 10,300 strike probabilities are almost the same. So that also we need to ignore that, because either of the one will take place. But the probability of 11,000 is only 3%, so which is very less, because the decay is happening. So that means the institutions are more active in call writing rather than call buying. So that is the reason we can conclude that the institutions are more active in call selling rather than call buying. So the call buying happened only because of the call buying is only by the retailers and not by the institutions. That is what the conclusion will say. So the retailers were continuously bullish, but that doesn't mean the market will move up to 11,000, because the retailers will never take this market to that much level. That much cash buying, who's going to do? So unless and otherwise FIIs or DIIs do, the market will never go to 11,000. So unless and otherwise institutions are not buying the calls, then definitely that will not happen. So the probability is very less, and the probability of 10,200 is more than the probability of 11,000 strike hitting. So 10,200 strike hitting is probably more compared to the others. So in conclusion, what we can say is that 10,000, anything market opening, even on tomorrow, if market opens a gap down and it opens around 10,300, below 10,300, then definitely the market will be taken down to 10,200 and then below levels, because that is what clearly visible here. So if it is a gap up above 10,500, then again the selling can happen because of the call writers. So that is what clear on the option chain, but the range is 10,500 to 10,000. That is what clear in this option chain this week. So now we move on to the price action here. So in the price action we can see that this range, this sell zone, that is 10,300 to 10,550 will be acting as a strong sell zone, and it will be a resistance one. So sustaining this level will be a huge volumes need to be there, but volumes are not seen in the previous days. So the market can fall from here, and will definitely take support at 10,000 level, that is 10,025, and this trend line. And the next support will be at 9,735 and 9,600. So this will be a support here. So here the range bound sessions will be seen here, but once breaking this 9,600, there is going to be a big fall from here to 8,800 level, and from there to 8,000 level. So this area will be a trading zone. So once broken, then other levels can be seen as per the price action, but upside is very limited. That is what we can see. A closing above this, that is 10,550 level, a big candle above this 10,550 can confirm the up move with volumes. Now we move on to the intraday setup. So intraday, see a strong resistance here. So even though there was an up move, it did sustain. There was a selling happen. So now we need to look for is 10,200 will be a support, and 10,140, this zone will be a support zone. Breaking that will definitely take this to 10,000 level. That is what visible here. And the 20 EMI is currently on the day chart is around 10,040, and this week's level is also same. So we can expect the touching of EMI 20 will happen at this in this week. So the range is this 9,995 to 10,400 or 10,500. So kindly share and like this video. Thanks for watching. Thank you very much.